Good afternoon. I'm Ray Farrar, Chair and CEO of ProVise Management Group, and we're delighted to have you here this afternoon for our webinar on ESG investing. That's environmental, social, and governance. With me this afternoon is Daniel Mannix. Daniel is a chartered financial analyst, CFA. He joined ProVise about a year ago. We rescued him after a 12-year career in New York and most recently from Raymond James. He is a USF grad and is now serving on the advisory board for the University of South Florida's Merrill Lynch Wealth Management Center, where I serve on the Dean's Advisory Board for the College of Business, the Kate Tiedemann College. So with that, Daniel, let's get started. Oh, ground rules. Ground rules are you won't be able to talk to us, but we would encourage you to use the chat feature, if you would, to ask any questions. We'll try to integrate the questions as we go along. We'll certainly do it at the end, and if there are any questions that we can't get to today, we'll be sure to send out a response to everyone. So Daniel, with that, tell us a little bit exactly what is ESG in a very broad sense, and what are the different pieces of which make it up?
Sure, good to be with you today, Ray, and thank you all for joining as well. So ESG is an acronym, and it stands for Environmental, Social, and Governance. And what it refers to is really investing that takes issues within those categories into consideration when coming up with the value or the relative attractiveness of a company. Let me give you some examples of each category. Environmental includes things like natural resource usage, waste management, carbon emissions. Social issues are things such as diversity and inclusion, which was big in 2020. Access to healthcare, privacy and data concerns. And governance is things such as board quality, executive compensation, accounting policies, really anything to do with business ethics. So the reason why these categories are so important is over 80% of the S&P 500 total market cap is made up of what's known as intangible assets. Intangible assets are things like brand value, supplier and customer relationships, intellectual property, public rights. These are intangible assets, and poor ESG management in categories like human capital, supply chain, anything to do with the environment, pollution, let's say, for example, all of those things will have a negative impact on the value of the intangible asset, and therefore a negative impact on a company's stock price. And so when investors take ESG criteria into consideration, they're really helping to minimize exposure to companies that could pose a greater financial risk. Think of things like the BP oil spill or the accounting debacle at Wells Fargo.
So when those things happen, the accounting debacle being a governance issue and the oil spill being environmental, you're saying it has an impact on the value of the stock itself.
That's absolutely right.
That's one of the reasons why it's important to investors.
Absolutely.
So take just a few minutes. There's different types of ESG investing that's going on. Which ones seem to be the most popular?
All ESG is not created equal, and there are several different categories of ESG investing. I'll run through them here with you. Think about it as a spectrum, and on one end of the spectrum, you have what's known as exclusionary screening, and it's exactly what it sounds like. You're excluding certain sectors and industries from the investable universe, usually companies involved in things like tobacco or firearms, fossil fuels, gambling. It really is one of the first types of ESG investing. A little lighter version of ESG investing is what's known as ESG consideration. And the investment manager simply considers ESG criteria as part of a, I would say, secondary valuation metric or valuation tool when assessing the value of a company. One step further would be ESG integration. And that is simply just integrating the ESG criteria into all facets of the investment decision-making process. Impact investing is another kind of ESG investing, and that's where capital will go to underserved or underrepresented sectors and communities. Think of things like affordable housing. The low-income housing programs in the United States are a great example of impact investing. And lastly, sustainable sector investing is anything that has to do with the green economy. So think of a green bond where a company raises debt capital to fund the building of a wind turbine to harness wind energy. As far as popularity, globally speaking, exclusionary screening is the most popular type of ESG investing. But actually here in the US, it's ESG integration. And interestingly, the recent growth in ESG funds that you've seen are kind of a hybrid of the two, of exclusionary screening and ESG integration. As far as which is the best, it really just depends on what kind of values you're trying to incorporate within your investment portfolio.
Sure. So how do I tell the good guys from the bad guys? What's the regulatory landscape? Who's monitoring and who's making the decision about the good companies versus the bad companies?
Absolutely. So good is a relative term, especially in ESG land. And you have to be really careful about how you're comparing an investment on an ESG basis, because there are the different issues within ESG categories have a different impact or weighting on a company. For example, carbon emissions are going to have a heavier impact on an oil refiner than they are for a bank, let's say. So you have to be careful about what you're comparing. It's hard to compare against sectors, and I'd say it's also difficult to compare against geographies just because of the different political regulatory landscape in different countries. And so what we're comparing is there's several data providers that gather a ton of information from companies and regulatory agencies and industry data and blog posts, anywhere where they can get information. And they come up with all these different impacts that a company has in regards to the different ESG issues. And they'll come up with a weighted score or ranking of that company. And this is really the best way to look at the ESG impact of an organization. And it's important to be looking at reputable companies that are gathering this information and coming up with these scores. And the reason why it's important is because, of course, the score is only as good as the input, right? So it depends on what kind of information those companies are able to gather. And the reason why there's differing levels is alluding to the second part of your question. ESG investing has been around for quite some time now, but there still is no standard regulatory disclosure required for public companies as far as their ESG impact. And so what this does is it causes potential lack of transparency and accountability and opportunities for greenwashing. We at ProVise believe that it's really only a matter of time before the SEC steps in and comes up with a standard disclosure requirement for public companies. I would point out the European Union is a step further than us in this regard. Just last week, they came out with the SFDR, which is the Sustainable Finance Disclosure Regulation, which says all investment managers that have a fund that they claim to be an ESG philosophy, they have to disclose tangible, objective, material ways that they are coming up with this score for the companies that they're investing in. And it impacts the US in the sense that this is for any investment manager, any fund provider that has clients in the European Union. So that can be a US fund provider with a European Union client. Again, I suspect you could see something similar to this coming from the regulatory side in the US out of the SEC. The investment management industry has been pushing forward with ESG. There's an international network known as the PRI. It's the Principles for Responsible Investing, and it's an international network of over 3,000 signatories representing over $23 trillion in assets. And they voluntarily adhere to 6 principles. And what the principles basically say are, we're going to take ESG criteria into consideration when we are coming up with our investments. And we're also going to push the companies that we are investing in to disclose more ESG information. Again, trying to get some transparency and accountability out of the market, which is great. And it really starts at the top. BlackRock, who is the largest asset manager in the world, just last year, they committed to have all their active portfolios consider ESG criteria in their investments. They also came out with a climate version of Aladdin, which is their risk management tool, a very popular risk management tool in the industry. This year, just recently, they announced that they are going to have all of their $7+ trillion in assets be invested in companies that have a plan or a commitment to being net zero carbon emissions by no later than 2050.
So this is not just a passing phenomenon.
No.
It's something that looks like it's going to be here to stay. But you have to be careful because since there's no standard, at least here in the U.S., people are scoring things in a different way. And then I can imagine that because it's becoming so popular and so important, that there are some people who are claiming to be good guys when in fact they're not, and it's gotten a term all to its own called greenwashing, kind of like whitewashing that we would think from a fence of covering things up. So talk a little bit about greenwashing and what's happening in that area.
Sure. So that's exactly right. It's greenwashing is a ESG play on the term whitewashing, and it's just referring to any company or investment manager or fund provider that is painting a company or an investment in an environmentally or socially friendly light, using some false or misleading information. And it is something that investors need to be cognizant of because, as you pointed out, there is no standard disclosure requirement currently in the US, which again is why it's important to make sure that if you're using ESG scores, you're using a reputable company, a reputable provider such as FTSE or MSCI or two that I would.
And FTSE and MSCI, what are those for those that may not recognize those in acronyms?
Sure. So those are index providers. FTSE more popular in the UK and Europe, and MSCI more specifically in the US, but they both have global indices. They are data aggregators. They have come up with internal scores, again, as I spoke about the weighting of these different issues within the ESG categories, coming up with these scores of companies. But even that needs to be taken with a grain of salt in the sense that this is such a fast-moving industry that it's difficult to even compare a company from 2 years ago versus what their score is today, because they could be just disclosing more information, and it just so happens that more information is negative on an ESG basis. And so it might look like their score is deteriorated when in fact it hasn't. And this can also be the case if a company in sector A has more disclosure than another, and the disclosure is negative, so then it gives them a negative score, whereas the competitor could have just as negative information, just doesn't disclose it.
So investors really need to dig deep when they're looking at this. Now, ESG is not a brand new phenomenon. It's 10, 12 years in the making, but all of a sudden it just seems to have exploded. What's made it so popular and so important at this particular point?
Sure. So exactly right. ESG is kind of slowly and steadily creeped up in investors' minds over the last 10 plus years, but 2020 was really a transformative year for ESG investing. And I would say most specifically the social category. Diversity and inclusion was a big topic in 2020, as well as just within the realm of the pandemic. How investors were watching how companies were treating their employees. Were they providing a safe workplace that was sanitized? Were they being flexible with where people could work from? Were they helping with daycare needs? So the S portion had a big year in 2020. Same thing for the E. Electric vehicles, renewable energy, wind and solar, sustainable farming and forestry and agriculture are all big for the environmental side of things in 2020. And the G, corporate governance, continues to be in the headlines. Activist investors have been around for a long time. And unlike E and S, the G category a lot of that information does need to be disclosed by public companies according to the SEC. So we do get a lot of the G part. And so activist investors have been looking for poor corporate policies for quite some time now. Fat executive compensations, a lack of board independence. I don't see any sign of that slowing. On the social side, supply chain labor standards for the manufacturing industry, for example, companies like Nike have come up in the headlines in recent past. And then you look at privacy and data concerns with big tech. That was one of the big stories in 2020. So all of these different issues really, it's been some time coming, but 2020 was pretty transformative in a couple ways.
You mentioned compensation, and given the popularity of it and the importance of it, do you see boards maybe building ESG into the compensation models for the CEOs of companies?
Absolutely. We're already seeing that. Apple just recently announced, I think back in January, a couple months ago, that they were including some of these social issues within to make up 10% of the bonus pool for their executives. Other companies in the tech industry that already have it include Microsoft and IBM and Intel. And there's a big push for Google to do the same. So yes, that's something that you will continue to hear more and more about. Another thing that we're seeing on the corporate side is these corporations are creating executive roles to actually lead these ESG issues. Recent examples are Blackstone, which is the largest private equity firm in the world. They hired an ESG executive role. They created it, as well as Jones Lang LaSalle, a real estate company out of the UK, did the same thing. And so I think you're going to continue to see things like that as this becomes more and more important for investors, number one, and number two, as regulation rolls out. I think it just makes a lot of sense to have at the executive spot someone who's watching over and managing these issues.
So we've got a new administration in DC. The Democrats control the House, the Senate, and the White House. There was a lot in the Democratic platform around these different issues. Anything specific that you can see bubbling up at this point from a political standpoint, from a policy standpoint, that we might be looking to get over the next couple of years?
Sure. So the Biden administration and the Democratic sweep, if you will, in 2020 are an incremental positive for ESG investing. And I would say particularly the E. President Biden has already shut down the Keystone XL pipeline and recommitted to the Paris Climate Agreement. And he has promised to spend a lot of money on clean energy and climate research and getting the US to be a 100% clean energy economy and net zero carbon emissions by no later than 2050. And so these are big promises, and those are big catalysts for the E portion of ESG. Speaking about catalysts, other ones that come to mind, the biggest one I would say is, we're really still in the very early stages of the largest wealth transfer in the history of the US. You're going to see about $30 trillion in assets pass from baby boomers to the millennial generation over the next few decades. And millennials are looked at as being more sensitive to ESG issues and taking them more into consideration when they're looking at their investment portfolio, what the ESG impact of that portfolio is. Retirement plans is another potential catalyst. Actually, in 2019, less than 3% of 401k plans even had an ESG fund option, and only 0.1% of 401k assets were invested in ESG funds. And so there's a huge potential wave of ESG interest from the retirement side. And lastly, I would just say that there's never been more investment options for ESG investing. It was primarily originally all mutual funds, and now exchange traded funds have become the most popular investment vehicle. You can really build out a well-diversified, low-cost, tax-efficient portfolio using the ETFs, to again incorporate those values within your portfolio.
So as I'm an investor, obviously I'm in it to make money. Is there any data to support that a good ESG company performs better than a bad one, at least from an investment point of view?
The short answer is yes. Their ESG funds outperform their traditional counterparts, number one, and higher ranking ESG companies outperform the lower ranking counterparts. And 2020 was a big year for the performance of ESG. I say that because you alluded to it earlier, ESG investing has really only come into the forefront over the last 10 years or so, since the great financial crisis, really, 2008, 2009. And so ESG investing has enjoyed a 10+ year bull run. And the knock has always been, well, people are going to have bleeding hearts until they have a bleeding portfolio. So when there is a bear market, people are going to jump out of ESG and they're going to go into, safe assets from an investment perspective. And what 2020 did is it gave us a true market cycle and a real bear market. And the fact that the ESG version of the S&P 500 slightly outperformed the traditional S&P in 2020 is kind of a overcoming or a knock on the false narrative that ESG investing is really just a bull market luxury.
So I want to remind everybody, if you have any questions that you would like to send in to us, please use the chat feature down at the bottom of your screen and just type it in. And as we get closer to the end, we'll try to answer any questions that happen to come in. So since many of the people who are listening in today are clients of ours, what's the best way to be investing in ESG, and specifically, how are we trying to accommodate the clients who are interested in that area here at ProVise?
Sure. So again, going back to exchange traded funds, I would say that that's the best investment vehicle for the average investor. I talked about the tons of information that these index providers are gathering, and that's not cheap. They have large research budgets, and they are going to all these different avenues to gather this information. And it's really difficult for the average investor to do so. So through an exchange traded fund, an ETF that tracks an ESG index from one of these really reputable providers, again, you can gain access to really a diversified portfolio, leveraging the data gathering capabilities of these larger companies, all at a really low cost, and especially versus a mutual fund, let's say. And again, in a more tax efficient vehicle. So here at ProVise, we do use ETFs in our ESG strategies. We use a multi-layered approach, I would call it, where we start with an exclusionary screening filter for certain sectors and industries. And then
what would you be excluding?
We would be excluding things such as tobacco, firearms, some fossil fuels.
Okay.
So those are some examples of the exclusionary side. So once you've excluded those industries, you're left with this investable universe that you are then optimizing to maximize exposure to the highest scoring or highest ranking companies on an ESG basis. So it keeps you relatively in line with traditional benchmarks, but it's going to have some differences, of course, again, because exclusionary screening, that's going to skew performance somewhat. But that's the vehicle that we would recommend until there are more standard disclosures from a regulatory perspective.
So we've got a question that came in, and essentially it was asking, if I have an interest in this particular area and I have an account with ProVise, do I have to open up a new account mean, a lot of what we talk to the clients about is trying to simplify all the paperwork and everything. So do I have to open up a new account, or can it be incorporated?
No, not necessarily. You do not have to open up a new account. We can change your current account completely or partially to an ESG strategy. If you wanted to contribute new funds to the account and have them just exclusively for ESG investing, we could do that as well. Or if you would like to separate your ESG strategy from your other accounts, you can open up a new account as well.
Okay. Another question that we had come in is, what's the impact of ESG on our daily life, our spending, our expenses, any estate planning issues that we have to think about? And I have to say, as a sidebar, since the question talked about estate planning, as you were talking about, the greatest generation was, or the current generation of baby boomers, I am one, was going to pass 32 trillion on to the next generation. I hearken back to about 25 years ago when we were talking about the greatest generation. They were going to pass 16 trillion. So obviously a lot of wealth developed over that time period. But what are the practical impacts of ESG on our daily lives?
Sure. Well, I mean, you look at things on the environmental side, electric vehicles is really coming into the forefront. You're getting some competitors against Tesla. In the US, Europe it's more popular. Electric vehicles still only represent about 3% of the auto market in the US, but you've heard things from companies like GM and Ford say that, hey, there's going to come a point in time where we're not going to have any carbon emission vehicles, any fossil fuel vehicles in our lineup in the near future. I believe GM said 2030, which is really soon. So that would be one example. I think the social side, I would definitely point to diversity and inclusion. That's something that investors are looking more at for corporations, to have a clear plan laid out. Again, I pointed to Apple with their executive compensation in January, having some diversity and inclusion goals laid out. But I think you're seeing more and more of that social category, that social issue be pushed in light of different things that happened in 2020. As far as the governance side, that's something that probably has less of an impact on your personal life and more on a corporate life. But something, again, that is in the forefront of investors' minds, and for everyone that's working and has a retirement plan, that it's going to have an impact on your portfolio in one way or another.
I think, today with the electrical vehicles, it's so hard to find a place to plug in, more today than it obviously was a few years ago, but still not a vast array of places to plug in if you're going on a long trip.
Sure.
And as you were talking about moving more and more towards the electrical vehicles, I was thinking to myself, okay, so there's lots more electrical outlets, and it's going to be hard to find a gas station or diesel fuel if you need it. Another person kind of raised the issue about the law of unintended consequences. What if the government was picking the winners and the losers, deciding who wins in this game and who loses? What are the implications in that regard?
That is something that has been at the forefront of investors and citizens' minds for quite some time now. That isn't something new. I mean, specifically, I'm thinking of farmers with ethanol production, different subsidies that the government provides for different sectors is likely going to bring about some backlash. And anytime that we allow the government to take the place of corporations, we run the risk of those that are in governmental power making corporate decisions that they don't have industry expertise on. And so there's always a risk when the government's going to be getting involved in picking those winners and losers. And I would say the biggest risk is the subsidies. As far as disclosures are concerned from a regulatory body like an SEC, I personally don't see a problem with that, in the sense that in a free market society and capital markets, more information is better, and allowing investors to make the decisions on their own by having access to all the information, there's a better opportunity for them to make an informed decision.
So this next question makes me harken back to the book 1984, which we've obviously long passed, but it has to do with the push in our daily lives, the green initiatives, that they push us towards a certain lifestyle or towards a certain life. So the question was, do you think someday that people will get ranked or rated as to their own ESG and how diverse they may be, and friends, and how they treat their own lives, and people be graded in some way?
I am definitely not qualified to answer that question, but it's an interesting concept. When you look at some of the policing states and across Asia, I'm thinking of China, across parts of Europe, where there is, facial recognition of where you go, where you're spending your money. As we already know, there, I pointed to the social issue of privacy and data concern. That's one of them. Is okay, all of this information on everyone, all of the credit card expenditures, everywhere that you're traveling to, everything that you're doing is big business, and companies are paying a lot of money to gain access to that information. And so from a consumer perspective, just having a better understanding of who actually has access to your information, and every time you get an update on your iPhone for all of your apps, and actually reading all of those disclosures of what information they're gathering from you, is probably a good idea. But as far as what the future looks like, and the government deciding what the ranking of a citizen is, and how that corresponds to maybe their access to healthcare or the cost of healthcare, let's say, from maybe the environmental side, or their career opportunities based on different parts of S that they're involved in. It's really interesting to think about, but something that I hope I don't live to see.
Yeah. So you already talked about that at least last year ESG outperformed, and we're long-term investors, and so we'll have to take a longer term. But let's put the performance question on the side. What do you see as the emerging trends in this fast-changing industry within ESG?
The emerging trends as far as which sectors, or which?
Just what would you expect to come next as part of the next part of the process?
I would just expect more fund options. Continue to slice and dice, as you've seen in the larger ETF world of going to specific sector, going to more active ETFs. So you're actually starting to see some active management ETFs within the broad ETF space, and some are slow to adopt it. But as far as not disclosing all the information every single day as most ETFs have to, I think you can see more options as far as the funds that you can invest in different companies, and having different slices of the market to, again, be able to give yourself a customized view of ESG. And there's a couple examples of ESG funds out there that are relatively small on things, let's say, such as if you have Catholic views, or if you have Muslim views, or if you want to be invested in companies that have a certain percentage of females on the boards of the public companies that they're investing in. I think you can continue to see more and more options like that actually are of a decent size to where you're getting liquidity. And so it's really, again, just about ESG really at its core is trying to incorporate one's values into their investments. And so the ESG broad blanket might not incorporate, or it might include things that are not within your values. And so being able to be more customizable, I think, is the way of the future.
So you mentioned earlier, Europe has started to do some regulatory work in this area. SEC just formed a committee on it. There are no benchmarks today that when I think about that in terms of GAAP accounting, general accepted accounting principles, everybody knows this is the way you handle those finances.
Sure.
When and where would you expect those kinds of principles and benchmarks to come into the industry, at least for us here in America?
I would say very soon, especially with the administration that we have right now. I think it's probably been accelerated. I look at Canada, they're in the same boat. I would say that they're probably about the same speed as we are as to when it's going to happen. And when I say soon, I'm thinking over the next year or two, very soon. There's already disclosures in place that if there is a material impact on a company, based on these different ESG categories, then they need to be disclosed. But it's too vague. There's just not enough barriers or guardrails there as to what a company, when they actually have to disclose. And so they want to disclose less than more in some situations and for some companies, but that's not the case for all of them. I mean, there are a lot of companies that come out with an annual sustainability report. You see it a lot across the bank space where there's a 100-page report on everything that they're doing at all their branches for switching to LED lights and having more drought resistant landscaping, let's say, and what they're doing on diversity and inclusion. And so there is examples of companies that are giving a lot of information and some examples of when companies are not, because again, there's just enough wiggle room within the current regulation, but there is a framework in place to really just put a tighter clasp around what that exactly is. And so, I don't have a crystal ball, but I would say that it's in the next year or two.
Well, I got just a few more minutes. Back earlier, you talked about only 3% of retirement funds, or 3% have an opportunity to do some ESG investing. The past administration had kind of squashed the ability to put ESG into retirement plans. And the current one has already said, well, we're going to put those on the side and we're going to study more. Talk about the impact in terms of demand. If retirement plans were to become available to really be able to get into ESG in a major way, how do you see that driving prices?
That will definitely drive prices up for these ESG focused companies. Now, what the exact number is, it's kind of difficult to tell. The ESG world is growing tremendously and rapidly, but it's hard to put a number around what it is exactly, because again, there's all different types of ESG investing, and what one considers to be an ESG investment versus another can vary across fund providers and clients alike. But if you look at where you are at 1/10%, even if that went up to 10% of the market, which would be a drastic change, but I think within limits, it would be a massive increase. I don't have an exact number for you, but does it have a big increase to the price of those particular companies that are within those funds? It would depend on where the growth was, because if it's all in one specific segment, then yes, absolutely. So you see an example of that with ARC funds, which have been in the limelight recently. That they're focused on growth, U.S. growth companies across all these different types of industries, biotech and electric vehicles. Tesla is their largest holding in their flagship fund, ARKK. When there are outflows out of those funds, you see an impact on those stocks. And so there will be some kind of impact, but it's somewhat difficult to quantify because of the way that an ETF actually works with the creation and redemption, which I don't know if you want to go into the specifics of how that mechanism works exactly, in order to basically saying that there are There are a lot of people out there that are arbitraging any difference in the prices between the ETFs and the underlying stocks in order to, take advantage of those creations and redemptions. And so there can be short-term fluctuations, but longer-term speaking, as long as there's an efficient free market, there shouldn't be wild swings over the long term.
So you wouldn't expect a GameStop to occur in the ESG area. So we have one last question. Daniel, have there been any studies at all to assess the impact of companies that are compliant with ESG versus those that are not, in terms of safety, in terms of productivity, anything in that area that in the internal part of the company makes it intrinsically more valuable than it was if they were not being compliant with ESG?
Yeah, so going back to those sustainable reports, that's where they would disclose information like that. That we've changed out this many light bulbs and it saved us this amount of money, or we have increased the distance between our workers and we only have X percentage of COVID cases per our workforce versus the industry average of Y. Things like that are disclosed in those reports. As far as what the financial impact is of different internal decisions on ESG, I think that's something that those executive roles will really be focusing on. And this is something also that the accounting department in general is focused on in a lot of these larger corporations, as they're trying to wrap their arms around the value of some of these initiatives and how you value them on the balance sheet. Again, going back to where I talked about the intangible assets of a company, over 80% of the S&P 500 total market cap is intangible assets. That means that you can't really assign a value of it to any material object, a tangible. That's the highest it's ever been. And so I think you can start seeing potentially ESG initiatives within these intangible assets.
Great. Well, Daniel, thank you very much. And thank you for helping to bring ESG investing to ProVise.
Sure thing. Pleasure being with you.
This is the second of webinars that we've done in the last couple of months. Previously, we did one on What Now, Mr. Biden, after he had been elected, but before he went into office. We'll be doing other webinars as we go forward in the future, not just around the investing part, but lots of other areas. We do talk about financial planning for your life and your lifestyle. So we're going to do a few of these webinars on lifestyle issues as well. I want to thank everybody for joining us today. Again, if you have any questions, please reach out to your relationship manager, or I'm going to volunteer Daniel to take your phone call for the next couple of days as a follow-up. Thank you all very much for being with us. Be safe and be well. Thank you.